So we're going on with equity investment. So we've done, so like I always tell people, for equity, your reading one equity investment is cut into two parts. The first part is more generalistic. That's where we looked at market structure. We looked at security indexes, and we looked at efficient market hypothesis that we did last class. So now we're moving more into the core, which is equity investment itself. And the first reading is overview of equity securities. Yeah, overview of equity securities. So why equity securities? Importance of equity securities. Why equity securities? So basically, what is equity investment? What are equity securities? Stocks. Stocks are generally ownership, evidence of ownership claims on the company's net asset. So basically shows that you have an ownership stake. Shows that you have ownership stake in the company, and as a result of your ownership stake, you have claims to the company's net assets. And why net assets? Net asset is basically, if you're an owner of a company, you own the company's stock, you own the company's assets, basically, because the expectation is that the company has used for a small scale business. Let's start from there. That means the company has used your capital to buy assets in order to run the business, and or rather, in order to run the business and generate revenue, and also during the course of generating that revenue, the company had taken on some liabilities. So technically, the assets less the liabilities is what you own in the company, which is what we call in accounts the book value of the company. Yeah. So literally, the book value evidences what you own as a equity shareholder. Yeah. So why the study of equity? So why are we doing this? Basically, why are we looking or trying to understand equity investment or equity securities? First, the decision on how much of a client's portfolio should be allocated to equities affects the risk and return characteristics of the portfolio. So what do they mean by that? Technically, we have been preaching portfolio management, and the whole essence of investing is portfolio management, creating a portfolio that is well diversified, that incorporates equities, bonds, and all that. Yeah. And technically, you need to understand the characteristics of equity investment in terms of risk and return dynamics, and how that sort of also flows to the risk and return dynamics of your portfolio. That's what that first part is saying. Then the second part is saying different types of securities, equity securities, have different ownership claims on net assets, and you need to understand the risk and return of that. So technically, it's not just one equity. We have different, which is what we're going to learn today. We have several types of equity securities, and each one of them carry different investment characteristics as regards return and risk. So you need to understand which one, because technically, you need to align your own objectives in terms of risk and return to align with the risk and return that these different types of equity investments provide. Yeah. So finally, variations in the features of equity securities are reflected in their market prices. So it is important to understand the valuation implication of these features, meaning that the different equity securities have different features, yeah, which are different from their investment characteristics. So your investment characteristics just talks about risk and return, but there are some peculiarities about each of these equity securities that sort of impact their risk and return characteristics. So you need to sort of understand that, and that's the whole essence of why we're doing this. Yeah. So basically, just giving us an introduction, equity securities in the global market. equity securities in the global market, it's grown over the years, but fixed income seems still be the dominant factor. So yeah, so let's jump right into it. So the first side is, which is why I always tell people, the curriculum is always packed with a lot of information. Anyway, characteristics of equity securities. Yeah. So under this, we need to understand, we need to be able to describe the characteristics of types of equity securities, and we need to be able to describe differences in voting rights and other ownership characteristics amongst different equity classes. Apologies, I have a cold. Okay, companies finance. Yeah, so basically, let's get to understand equity securities, stocks. Let us call them stocks. Yeah. So let's understand the basics of stocks. When a company is raising capital, yeah, there are two ways for them to raise capital. It's either two predominant ways. It's either you're using equities or you're using debt. Now, we start with debt. When you go through debt, you are creating a liability. Remember when I said a company would use your equity to create assets, and during that to generate revenue, and during the operational activities of the company, they would create liabilities. So a typical example is debt. Yeah. So debt is more like a contractual obligation where you have to pay interest, and such that at the end it has a defined. So let's look at the features, because I like what the curriculum did. The curriculum first spoke to us about debt before moving to equity. So for debt, there's a contractual obligation. You will pay interest, or rather, let's start by saying, for you to take debt, there's a specified period. There is a contractual obligation that you will pay interest over that period, and at the end of the period, you will pay back the money that you borrowed. Yeah. That is, in summary, what debt is. But what is equity? First thing first, for equity, there's no defined period, meaning that you can own the company forever. Two, there's no contractual obligation on the company to pay you returns, which is dividends. So you can see the difference. And because there's no maturity, there's no defined period, there's nothing, the company is not obliged to pay you back the amount that it collected from you as equity. So it is very different from debt. There's no defined period, no contractual obligation. The company does not owe you dividends. The company does not owe you shares, does not owe you the value of your shares. The only thing the company owes you is what we're not going to talk about. So everybody will now ask, so what is the essence of me buying the stock of a company? What is the essence of me owning shares of a company? What are the benefits of me owning shares? And the curriculum first states with this to say that, firstly, yeah, the curriculum first says this: shareholders, your first benefit is that you have claims on the net assets, meaning that you have claims on the assets, and after the liabilities have been paid, meaning your net asset, you have claims to it. So as long as the net asset is growing, what your equity technically means that it is growing. Let me say that again. What the first benefit you have is that you are the owner. You have claim on the net asset of the company. As long as the net asset of the company is growing, the value of your equity is growing. So basically, what you should be looking at is that how is this company, or what is the ability of this company to grow its net assets? Because that is when the value of what I have given them is growing. That is where I am getting richer. Yeah. Now, there's something here I like. Because of this residual claim, Now, what do we mean by residual claim? Yeah, what do we mean by residual claim? Apologies. What do we mean by residual claim? What do you mean by residual claim? Now, residual claim means that, so what do we mean by residual claim? Now, there's something you need to understand about equity shareholders. So you guys must have heard of something called limited liability, or rather, so limited liability, meaning that, so limited liability comes from the angle of the fact that in the case of bankruptcy, you would lose everything that you have as your equity stake in that company in a case where liability needs to be paid. Now, nothing will come, you don't have to pay beyond what the value of the equity is. So that means that if I am the owner of a company and there's a bankruptcy and liability needs to be paid, and the value of the equity is, say, 20 million, and the value of the liability is, say, 40 million. Yeah. So it means that there's a possibility that I might lose, there's a possibility I might lose my equity stake. Now, but there will be no claim to my personal wealth. It's just for the stake that I have in the business. Yeah. Now, residual claim here means that in the case of a bankruptcy, the creditors of the company will be paid first. All liabilities, which is why we call it the asset after all liabilities. All liabilities will be paid first before they pay equity shareholders, or they pay shareholders. That's the liability, that's the residual claim. And that's where, from a risk perspective, that's the major risk that people that buy shares or stocks of a company, that's the major risk that they expose themselves to. The fact that everything that you have put in that company can be lost if there's a bankruptcy. Yeah. So basically, there's this part of it which is what almost in line with what I've said, to say that the whole essence is the major value to you as a stockholder, as a shareholder, or a purchaser, a buyer of a company's stock, is that you believe in the management of the company, that the management of the company will continue to grow that net asset value. And it is the growth of that net asset value that provides what we call shareholders' wealth. So at every point in time, if you do not believe that they can grow the net asset value, then there's no point, or maybe the net asset value has depreciated over time, then you should be a bit skeptical, because that's your major value. Yeah. So the curriculum says, in addition to common shares, we also have what we call preference shares. So there are two distinct types of stocks or equity securities. We have the common shares and the preference shares. Yeah. So common shares are the guys that we also call them ordinary shares. Yeah. And we have the preference shares, that the guys that we will also call preferred shares. So let us go a bit into the characteristics of these two types of equity securities. So common shares represent ownership interest in a company and are the predominant type of equity securities. Yeah. So common shares or ordinary shares are the predominant. Yeah. As a result, investors share in the, so this is very important. Yeah. Very, 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 very important. So as a common shareholder, you share in the operating performance of the company. Yeah. You participate in the governance process through voting rights, and you have a claim on the net asset in a case of liquidation. So those are the benefits and the rights to you as a shareholder. One, you have the right to vote. Two, you have the right to share in the performance of the operating performance of the company. And three is that you have the right to claim to the company's net assets in the case of the liquidation. Yeah. So a company might choose to pay out some. So basically, what is dividends? How do you benefit from the operating performance of the company? The company pays you dividends. So a dividend is a percentage of the company's profit at the end of the year. So a company might make a decision to say, you know what, we want to pay a percentage all. I know some companies that pay all of their profit. I know some that pay a percentage, you know, or they don't even pay at all. Yeah, so it falls in between those three spectrums. I pay you all, I pay you a percentage, or I don't even pay you at all. And like I mentioned before, the company is not obliged contractually to do that. Yeah. So let's talk about voting rights. So that's performance sharing, dividends. Another way of also giving back to shareholders, aside from dividends, is what we call bonuses. So I'm sure you guys must have heard of bonuses. So rather than them giving you the money, they'll use the money, they'll give you shares. Why some companies do both, meaning that they'll give you cash and they'll give you share dividend. So bonus is what we call share dividend. So they would convert your shares, your cash dividends, they'll convert it to shares and they'll give it to you. Yeah. Now, let's move to voting rights. Yeah. So voting rights provides shareholders with the opportunity to participate in corporate governance decisions, including the election of board of directors, the decision to merge. You know, so let me explain. As a shareholder, like I said, you are part of the owners of the company. And before the management of the company can do anything significant based on their memorandums of and articles of association, they have to get clearance from the shareholders. Yeah. And there's something we call majority shareholding vote. So meaning that majority of the shareholders must agree to what they want to do. So a typical example is when they want to elect shareholders. Another one, and that's the majority of the things they do at annual general meetings. So it's either they're electing shareholders, they're appointing auditors, they're sharing dividends. You know, they have to still get your approval to share dividends. There's also the part of maybe you want to do a merger or you want to do an acquisition. You know, those are things that they will always vote on. Yeah. So, like, which is what I just said. So the shareholders voting generally take place at the annual general meeting. Yeah. As a result of geographic limitations and the large number of shareholders, it is often not feasible for shareholders to attend the annual general meeting in person. So for this reason, we have what we call proxy. So they have what we call proxy. So vote by a proxy, which allows a designated party, such as another shareholder, a shareholder representative, or management to vote on the shareholder's behalf. So sometimes most organizations or some companies would tell their shareholders to nominate another shareholder. I cannot attend, yeah, your AGM. But now AGM is now online now. So a lot of people have been doing online AGMs. So thank God to COVID. So as a result of that, you cannot say that, obviously, but for reasons best known, some shareholders might decide not to just attend the AGM. Yeah. So, but the basic here is when you are unable to attend, you can vote by proxy, meaning you can elect a proxy, probably a director or a shareholder, existing shareholder, or someone that you have been able to communicate to the company that this person will be the person attending this AGM on my behalf, and this person will be voting. So a typical example is for companies, for shareholders that have their assets with probably a trustee or with a custodian, they might elect the custodian or the trustee to vote for them. Now, regular shareholders voting, where each share represents one vote. So there are different types of voting rights. Yeah. So we have what we call regulatory voting, and we have what we call cumulative voting. In the case of regulatory voting, yeah, your one share is, each share you have is equivalent to one vote. So that means if I have 1 million votes, I have 1 million. If I have 1 million shares, then I have 1 million votes. Yeah, so 1 vote is equivalent to 1 share. Although it is the common method of voting, it is not always the most appropriate one to use to elect board of directors. It's better to serve shareholders. It's better serve shareholders who own a small amount of shares. Cumulative voting is always used. Cumulative voting allows shareholders to direct their total voting right to specific candidates, as opposed to having to allocate their voting rights evenly amongst candidates. Meaning that all your shares, if you are voting for one candidate, all your shares would be given to that candidate. Yeah, so cumulative voting rights allow shareholders to direct their total voting rights to specific candidates, as opposed to having to allocate their voting rights evenly amongst candidates. Total voting rights are based on the number of shares owned multiplied by the number of board directors being elected. For example, under cumulative voting, if 4 board directors are to be elected, a shareholder who owns 100 shares is entitled to 400 votes and can either cast all votes in favor of a single candidate or spread them across the candidates in any proportion. In contrast, under statutory voting, you have only 100 votes. So what they're saying there is, if I have 100 shares for statutory, I automatically have 100 votes. While for cumulative, my 100 votes will be multiplied by the total number of directors or directors that we need to vote. Yeah, such that you can decide to carry all the total votes, which is your number of shares multiplied by the total number of votes that needs to be made, and direct it to one shareholder. And the reason why we do that is because of share voting manipulation. Yeah, so some directors might do politicking, yeah, to go and meet the main people that have the highest number of votes and tell that one person to vote for them. Even though, so let me explain. So imagine that there are 10 shareholders of the company, yeah, and one party has 40% of the votes, and the remaining 9 who on a total accumulates to the 60% of the votes. So that means in this kind of situation, if I want to get something done by the shareholders, all I need to do is to ensure that at least the person with the highest shareholding votes for me. The moment he votes for me, what happens? I get one more person to vote for me. That's already 2 out of 8. Remember that the majority, technically, which is the 8 people, don't really want to vote for me. But because I've been able to get the person with the highest number of votes to vote for me, that person has already tilted the whole position to my side against all the number of people. And that's just one individual. So that's where voting manipulation comes. And that's what came about this cumulative voting and all that. Yeah. So a key benefit to cumulative voting is that it allows shareholders with a small number of shares to apply all their votes to one candidate, thus providing the opportunity for a high level of representation on the board that would have allowed by statutory voting, which is what I just tried to explain to you guys now. Yeah. Okay. So moving on. So those are the types of voting. You have the statutory and the cumulative. Now, moving on. Let's now move on to preference shares. So, like I mentioned, for common shareholdings, there are 2 things that you benefit from, which is the dividends and the voting right. Yeah, the company does not have any obligation to pay you dividends. However, you have all the rights to what? You have all the rights to vote. Okay, so now let us talk about preference shares. So preference shares rank number 1. They rank above common shares. That's why they are called preference shares. So they get preferential treatment. So technically, what we're saying here is if you are for preference shares, they rank above ordinary shares in the instance of a bankruptcy, and also in the instance of dividend payment. Preference shares always get their money first. However, for preference shares, they get dividends on a fixed rate, meaning that for ordinary shareholders, your dividend is not fixed, meaning that if I'm going to pay you dividends, the company can decide what percentage of that earnings will be paid as dividends. However, for preference shareholders, it is agreed ab initio. So there's a contractual agreement that a fixed amount will be paid regardless of earnings. So if the company cannot pay, if the company wants to pay dividends, the company must first pay preference shares their fixed amount before they now pay ordinary shareholders what is entitled to them. So technically, we always call preference shareholders like hybrid between they sit in between dividends and ordinary shares. So they get fixed interest payments like the debt holders. Yeah. They also have a tenor. In some cases they have a tenor. Yeah, which is what we call redeemable preference shares. They have a tenor. Yeah. However, they don't have voting rights. So if you think about it, they are like debt holders, to be honest. So if you look at what they say, similar to interest payments on debts, their dividends are fixed. Yeah, they run for a particular tenure. They also don't have voting rights. So preference shareholders don't have voting rights. Yeah. However, they rank subordinate to what? To debt holders. Yeah. So in some instances, they are what? Like I said, they are fixed, and in some instances, they are what? They are perpetual. Yeah. So now different types of preference shareholders. Now, sorry, different types of preference shares. For preference shares, your dividends, your types of preference shares are dependent on what happens to dividends. Yeah, what happens to dividends? So from a dividend perspective, so we have cumulative preference shares. So cumulative preference shares is a plan of preference shares that in a year where dividend is not paid. So let me go back. For preference shareholders, you only receive dividends when the company wants to pay dividends. So if the company does not pay dividends, you are not receiving dividends. That's just the difference between the debt holders and the preference shareholders. It is at the obligation or the discretion of the company if you are going to get dividends. However, if the company decides to pay dividends, you are going to get a fixed amount as agreed. Yeah, you are going to get only when the company declares dividends. If the company does not declare dividends, you are not getting any preference shares. Now, that is where cumulative preference shares comes into play. How? The years where the company does not pay dividends, the preference shareholder does not get dividends. However, the year the company decides to pay dividends, it must pay the arrears of dividends that it did not pay the preference shareholders before it pay ordinary shareholders. Let me say that again. So let's just say, imagine that a company has preference shareholders, and in the last 3 years, he has not declared dividends. Remember, it is when you declare dividends that the preference shareholders also get dividends. So he hasn't declared dividends in 3 years. Now, on the 4th year, he now decides to pay dividends. Now, what cumulative preference shares is saying is that those 3 years that he did not pay dividends, he has to pay the dividends on those 3 years first, plus the 4th year, before he pays ordinary shareholders. That is what cumulative preference shares is saying. Now, non-cumulative is saying that does not happen. Yeah, so meaning that the year I don't pay dividends, you don't get those dividends in the future. It does not accumulate. Now, participative dividends, participative preference shares, shares entitle the shareholders to receive the standard preference shares plus the opportunity to receive an additional dividend if the company's profit exceeds a specified level. So let me explain. Remember that we said dividends are a percentage of profit, and preference shareholders get from that percentage before ordinary shareholders. So let me use an example. So a company has a profit of 10 naira, and it says that 10 naira per share, and it says that it's going to pay a dividend of 5 naira per share. Now, preferential shareholders are meant to get 1 naira per share every year. So that means if the company declares 5 naira per share, it will first pay 1 naira per share to the preferential shareholders and pay 4 naira to the ordinary shareholders. Now, what participatory preference shares is now saying is that in a case where the company exceeds profitability of 10 naira, that amount that has exceeded the level of the amount that is in excess of that 10 naira, the company is going to, the preference shareholders are going to get X percentage of it. That's what we call participatory preference shares. So it means that if the company now next year 2 gets 11 naira, preferential shareholders are saying, okay, we're going to get 10% of that. So it means that you will pay me by 1 naira and you will pay me 10% of the 1 naira at which your current profit is above 10 naira. So that means that the preferential shareholders are going to go with 1.1 naira per share. So that is what participating preference shares is, while non-participating preference shares does not incorporate that. Now, we have what we call preference shares that are convertible preference shares. So convertible preference shares means that at a point in the future, driven by a liquidity event, preferential shareholders are going to convert their shares to ordinary shares. That's what we call convertible preference shares. Yeah. Now, what are the benefits and advantages of convertible preference shares? One, they allow investors to earn higher dividends than if they had invested invested in the company's common shares. They allow investors the opportunity to share in the profit of the company. Remember that for preference shares, yeah, your dividends are fixed at 1 naira. So imagine that there's no participating. Your dividends are fixed at 1 naira. And this company grows astronomically over the years, that the company has and is declaring dividends of, say, 20 naira per share. And you are still fixed on your 1 naira per share. You will vex and do what? Convert it to ordinary shares so that you can benefit in the what? In the 20 naira per share. Yeah. So they allow investors to benefit from a rise in the price of the common shares through conversion option. That is another point. Preferential shareholders, your shares value do not rise. Like I said, they're like debts. It does not rise. Only if the company decides to put a convertible preference shares for you. And that's why most people issue, or most investors always ask for convertible preference shares, so that in the future, when the company's value has risen significantly and there's some significant growth prospects, I convert to common shares so that I can benefit in that growth prospects. And once I benefit, I sell off the shares and I have my money in hand. The price is less volatile than underlying common shares because the dividends paid are known and more stable. Yeah, which is general for preference shares. So as a result, the use of convertible shares is a popular financing option in venture capital and private equity transaction, in which the issuing companies are considered to be of high risk, and when it may be years before the issuing company goes public. So, which is what I just mentioned to you guys now. It's one of the methods that equity shareholders are always looking to provide funds to companies. We'll give you preference shares, convertible preference shares. We look at how your performance is in the next 5 to 10 years. So let's just say 6 years, 6. If you have grown significantly and you're doing well, we convert to ordinary shares and we become shareholders of the company. Okay, moving on. private versus public equity securities. So another type or classification of equity securities is in the space of what? Private and public. Yeah. So private, for me, as simple as it is when a company issues shares, a private company issues shares or makes available its shares for purchase. That is already private equity securities. When a public company offers shares to the company, or rather, let me rephrase. A private limited liability company, the shares of that company is private equity securities. A company that is listed on an exchange is a public listed company or public limited liability company. The shares of that company is what? Is public equities. Now, private equity can offer shares, or a private company, limited liability company, can become a public limited liability company by doing what? By becoming listed and doing a initial public offer, an IPO. Yeah. So a company just like what's the name of that company? Just like Transport Power. Transport Power just got listed on the Nigerian Stock Exchange, and even though they did not do an IPO, they did what we call a listing by introduction. So hence, their shares are no more privately owned; they are now what? Publicly owned. So that's basically the difference. Now, another difference is for shares or stocks of a private limited liability company, you cannot issue your shares to the public. So if you are looking to raise funds through equity, you will most likely be doing it in a private space, which is what we call private placement. So, and for private placements, based on regulation, you can only issue to HNIs, or what we call qualified individuals, investors, HNIs or institutional investors. Yeah, you can't go to an exchange. In order for you to do that, you have to do what? You have to become a listed company and you do an IPO. Yeah, so there are three types of private equity investments. Yeah, there are three types of private equity investments. We have venture capital, leverage buyout, and what we call PIPE. Yeah, so venture capital investments are investments that you make to start up companies. What we also call seed capital, yeah, or mezzanine financing or early stage financing. So when a startup company is looking for capital, yeah, or seed capital to start their business, to bring their idea to life, that's what we call venture capital. The riskiest of private equity investing, which is venture capital. Yeah. Then we now have, which are things that you see in your alternative investment. We now have what we call leverage buyout. So leverage buyout is when a group of investors borrow money in order to be able to acquire a company. And most times it is always to acquire a public company and take the company private. Yeah. Another one is called management buyout. So management buyout, a typical example is my organization. So sometime in 2012, we used to be a subsidiary of Skybank. And when, what's that guy's name? Sanusi said banks should divest. The management of Skybank decided to do what we call a management buyout. It also happened with, I know it also happened with Owando. At a point in time, Owando was divesting some of his subsidiaries. So rather than selling the company or looking for an investor from outside, the management of the company decided to do what we call a management buyout, which is when the management of the company decides to buy off that arm of the business. So that's management buyout. Now, the third is what? PIPE, private investment in public entity. Yeah. So at times, some companies might be cash strapped. So a typical example is if you're a very in tune with the American market last year, you must have heard of a company called Signature Bank. Is that not what the name of the company is? Signature Bank. I think it's Signature Bank. What's not that company? That company that ran in that became that ran into issues last year. Forgetting the name. Apologies. So that bank was actually soliciting for a pipe and was actually speaking to Warren Buffett for Warren Buffett to buy out the shares, to own significant shares in the company and sort of create liquidity for the company, because the company was running into a liquidity event. But that didn't span out. That didn't go well. So at the end of the day, the company had to run into issues. But what we're just talking about here is a company might be public, might be a public entity, and the entity might be looking for cash or looking to raise capital, which I believe majority of, that's another one. So given this current banking recapitalization that has been given, you will see a lot of companies a lot of this bank might go into what we call PIPE, which is private investment in public. And so they might, in order for them to buffer, to make up for that differential in capital, they might decide to create more shares, and probably look for an individual that can sort of, or a group of individuals, but probably predominantly an individual or even an entity that might be willing to sort of buy out those shares or buy those shares and become maybe a significant shareholder in the company. Some might even decide to do IPO, but we never. But basically that's what PIPE is. So when a company reaches out to an individual to offer that individual or group of individuals investment stake in their business. So it's very much different from IPOs or seasoned offers where the company does it to the public. So that's different. So a public company offers shares, a publicly listed company or a publicly limited liability company offers shares to the public through what we call seasoned offers. So telling the people to say, oh yeah, I need shares, like come and buy. Yeah, I need money, come and buy my shares. Or it looks for one or two individuals that have the capital capacity. It goes to them and he offers them his shares. Yeah, so that's PIPE. So this is just a lot of, like I said, the curriculum has a way of gathering a lot of gist. Yeah, so basically those are the differences. Private companies versus private equities versus public equity. Now, the curriculum moves further to talk about non-domestic equity securities. Non-domestic, so meaning that if you want to invest in international stocks, yeah, so let's imagine that you're in Nigeria now and you want to invest in the American Stock Exchange. That's what we're talking about as non-domestic equity securities. It's kind of interesting that the world is now a global space. Technology has sort of linked us. I can remember as far back as 12 years ago, I met a firm that wanted to be trading, they wanted to be investing in the American Stock Exchange. At that point in time, 12 years ago, it was like the biggest thing to have heard at that point in time, that somebody in Nigeria is buying stocks in the American Stock Exchange. It was a big deal. But fast forward now, 12 years after, it sounds like gist. Because if I want to buy stocks, I can just go to Bamboo and buy. I can sign up to trading platforms from Nigeria and sort of buy the stocks I want to buy. So that barrier to investing globally has significantly sort of watered down. It's not more a big deal, but the curriculum still speak about it and says, okay, what are the different ways you can do direct investing, which is what I just mentioned now. I use my money, I sign up to a platform, Bamboo and the likes, and I buy the shares and I become a shareholder of Amazon, shareholder of Netflix and likes, without stress. So that's direct investing. Another one is depository receipts. So what do you mean by depository receipts? So a typical example is Amazon or Google can realize that there are a lot of Nigerians that are interested in their shares, and probably they are finding it difficult to sort of buy directly, maybe due to capital market restrictions and all that. So what can Google do? So Google can say, okay, can allot a percentage of its shares and bring that shares to probably a custodian in Nigeria. So let's say probably brings it to Stanbic IBTC nominees to hold. So let's say it's giving nominees 1 million units of its shares, Google now, probably valued at, let's say for instance, $1,000 per unit. So that's almost close to $1 billion has been dropped with Stanbic IBTC nominees, such that Stanbic IBTC nominees will now create what we call receipts, which is its depository receipts. Now create what we call receipts. So receipts is just technically saying evidence of ownership, or those shares are being held with Stanbic IBTC nominees. Then Stanbic IBTC nominees now goes to the Nigerian Stock Exchange and lists those receipts on the Nigerian Stock Exchange. So Stanbic IBTC decided to say, okay, let's create one for one. Yeah, so 1 million receipts, such that it will now trade on the Nigerian Stock Exchange. But the challenge here now is exchange rate. So it will not obviously offer those shares at $1,000. So most likely have to offer it in Naira. So that's where exchange rate differential comes into play. So a typical example is GTB has depository receipts. So GTB has receipts in London Stock Exchange. So they deposited some of their shares with the custodian. The custodian created receipts and listed those receipts on the London Stock Exchange. So you can actually be in London and be buying the shares of GTB and benefit and become a shareholder of GTB. And GTB will pay you your dividends. But remember, because it's listed in London, it will not trade in Naira. It will trade in pounds. So, and dividends are paid in Naira. So at every point in time, dividends are being paid. GTB has to convert those shares to pounds or dollars, depending on the agreement that they've had with those shareholders, and remit those shares to those shareholders. So that's what we call depository receipts. The depository bank or custodian bank is what I just mentioned earlier. A typical example is Stanbic IBTC. Now, we have what we call sponsored and unsponsored depository receipts. A sponsored depository receipt is if the company, the issuer of those shares, is in support or is the entity that drove the existence of the receipt. So a typical example, like I said, is GTB. GTB were the ones that decided to do their depository receipts in London. So it's a what do you call? It's a sponsored DR. Yeah. However, we have the unsponsored. Unsponsored means the company does not have any business about it. So an individual can wake up one day and decide to accumulate shares of Tesla and decide to bring it to Nigeria, create receipts, and list it on the Nigerian Stock Exchange. Nobody is going to hold you ransom to that. The only thing they hold you ransom is that for the dividends that are being paid on Tesla, it must get to the owners and holders of the depository receipts. So those are unsponsored and sponsored depository receipts. A typical example, what you need to know is that majority of the Chinese shares that trade on the American Stock Exchange are actually depository receipts, not actual shares of the company. Yeah. So there's something you hear, global depository and American depository. I always say it, America has a big problem. America likes to always be different from the world. So they are all called GDRs. But when it comes to America, America has said you cannot call it GDR, you must call it American Depository Receipts. There's really no difference between GDR and ADRs. No difference. It's just America decided to say that as long as you're coming to my market, you have to call it what? ADRs. Yeah. Okay. So moving on, risk and return characteristics of equities. Risk and return characteristics of equities. Okay, risk and return characteristics of equities. Compare the risk and return characteristics of different types of equity securities. Remember, I told you there are two types: preference shares, common shares. Common shares, preference shares. So, but generally, speaking about equities, what are the returns that are attributable to you if you invest in equities? So it's either you have price change or you have dividend income, yeah, or you have both. So for companies that don't pay dividends, the expectation is that they will continue to grow their net asset value, which is their book value, and the growth in their book value should reflect in their prices naturally if there are no other factors driving that transition, meaning that maybe the company is in bad news, the bad management, but as long as that net asset value or book value is growing, there should be that positive flow correlation to prices in the market. However, if the company is not focusing on that, the company might be focusing on paying you dividends, or the company gives you both. Yeah, and that's why your total return for equity investment is given as this formula. This is the formula that you all know, which is your price at time t minus price at time 0 divided by price at time 0 plus your dividend at time t divided by your price at time 0. Yeah, so right now this is price appreciation, this is price appreciation, and this is dividend income. Yeah, if a company doesn't pay dividends, it will most likely be only price appreciation. But now the curriculum is now saying that in a situation where you are buying foreign stocks, one factor that would also be incorporated into this return is your changes in FX rates. Yeah, your changes in FX rates. So are you experiencing foreign exchange gains or you're experiencing foreign exchange losses? It all depends on what you are looking at. Okay. So moving on. So those are the returns. Now let's talk about risk. So if you invest in equities, what are the risks that you are exposed to? Now, the risk of any security is based on the uncertainty of future cash flows. I always say this all the time. Yeah, the risk that you face is the uncertainty of future cash flow. So the more uncertain the future cash flows, the larger the risk. And if you remember, for ordinary shares, what did I say about ordinary shares? For ordinary shares, the company does not have any obligation whatsoever to deliver dividends to you and to deliver price appreciation to you. So technically, your future price or your future cash flows are very uncertain. So, and the greater the uncertainty of cash flows, the greater the risk, and the more variable or volatile the price security. Yeah, so if you look at a preference shareholder and a common shareholder, the preference shareholder has less risk than the common shareholder because one, your interest, your dividends are what? Are fixed. Yeah, even if the company does not pay dividends, you know that, imagine if it is cumulative, it means that the day they eventually pay, they will pay you all the arrears. So basically, if you look at the two types of equity securities, common shareholders are what? Are more risky. Yeah, are more risky. Okay. The curriculum comes here to say a variety of different methods can be used to estimate an equity's expected total return and risk. One method uses the equity's average historical return and the standard deviation of this return as proxies for expected return in the future. Another method involves estimating a range of future returns over a specified period of time, assigning probabilities to those returns, and then calculating the expected return and standard deviation of it. So it depends on what you look at. So the type of securities as well as its characteristics affect the uncertainty of future cash flows and therefore risk. In general, preference shares are less risky than common shares for these three reasons, which is what I've mentioned now. One, your dividends are known and are fixed. Two, when dividends are paid, you receive dividends first as a preference shareholder than a common shareholder. And lastly, in an event of bankruptcy, you will be paid your preference shares amount, investment amount, before common shareholders even consider anything. So because of these three reasons on its own, preferential shareholders have a less risk than what common shareholders. So if you are running away from risk, but you still want equity, then you can go to what? Common shareholders. Sorry, you can buy preference shares first. Okay, so those are the returns and risk characteristics of equities. Now let us now move to the next reading, next section, which is company equity and company value. Equity and company value. And under this, we are looking at explain the role of equity securities in the financing of a company's assets. Explain the role of equity securities in the financing of a company's assets. Contrast the market value and book value of equity securities. And lastly, compare a company's cost of equity, its accounting return of equity, and investors' required rate of return. Okay. So let's jump right into it. Companies issue equity securities on primary market to raise capital and increase liquidity. I've said that earlier. I gave you the instance of the bank. What's on that bank again? Signature Value Bank, or Significant Value Bank, SVB.
Is this Silicon Valley?
Thank you very much. Silicon Valley Bank. God bless you, Jare. That's the bank I've been trying to remember. Silicon Valley Bank. Yes. So that bank was a bank that went down last year. So the reason was they wanted to increase their liquidity and they wanted to raise capital. Yeah. So this additional liquidity also provides the corporation an additional currency, which it can use to make acquisitions, provide stock options, and so the primary goal of raising capital is to finance the company's revenue generating activities in order to increase its net income. So this is very important. Yeah, very, very important. The primary goal of raising capital is to finance the company's revenue generating activity in order to increase its net income and maximize shareholders' wealth. Now, remember what I said is in a company, what is your natural wealth? Accounting 101. Assets minus liability equals to your equity. You can all remember this equation. Now, your ending value of your equity is equals to your beginning value of equity plus what? Plus net income. So you can see where net income is very, very important. So your net income, as long as your net income is growing, yeah, this guy is also what? Growing. Hence, this guy is also what? Growing. And that is why most investors don't focus on anything apart from what? How your PAT is what? How your net income is growing. The only thing that can make this guy change back to accounting 101 is your ending value of equity is equals to your beginning value of equity plus net assets plus net income minus dividends. Now, this is the reason why a lot of companies don't pay dividends, because a company that wants to grow the shareholders' value very fast would not pay dividends. And as long as they know that they have the tendency to generate high net income, they will not what? They will not pay dividends, because with that, their net income can grow very fast. And remember what I said, there should be a positive relationship between this value of your book value and your what? And your market value in the market. Yeah. And with this is how they maximize shareholders' what? Shareholders' wealth. In some cases, yeah, so the ultimate goal of management is to increase, which is what I've mentioned here. Remember, I've mentioned this earlier. The ultimate goal of the management is to increase the book value of the company and maximizing the market value of equity. Yeah. So one way to maximize market value is to continue to increase your what? Your book value. And I've mentioned here that one way you can increase your book value is by increasing your what? Your net income. Yeah. Although management actions can directly affect book value of the company, they can only indirectly affect the market value of the company. Remember, I said that, I just said that now. What the management has power over is the book value. And the only way they have power over the book value is through net income. Your market value, they don't have power over it. But the expectation is that if we continue to do good with our book value, it will translate to our market value because investors will continue to like us. And the only way investors can show their likeness for us is by buying our shares. And the more they buy our shares, the more the market value start to increase. And that's why Warren Buffett would always say that he loves companies that are doing well, but investors are not seeing or don't appreciate that doing well. Those are the kind of companies that Warren Buffett likes. I see a company that is doing well, a company that is growing its net income, a company that is growing its book value, but the market doesn't just like that company. The market is not just seeing that company in a good light. Warren Buffett likes companies like that. So I've said everything here. I've said, yeah, the book value of the company increases when companies retains its net income. Yeah, the more net income that is retained, the good your book value. Yeah. So the market value of the company's equity, however, is a reflection, reflects the collective and differing expectations of investors concerning the amount, timing, and uncertainty of the company's future cash flows. So like I said, your market value cannot be controlled by the company. It's controlled by investors. It looks from the perspective of how investors perceive what the management and what the company is doing and what the company is achieving. So if I like what you are doing as a company, the only way I can react to that positive thing that you're doing is by what? Going to buy your shares. So like the curriculum has said, the market value of your equity is a reflection of how investors perceive your company in a nutshell. Yeah, rarely will, this is very, very right. Rarely will book value be equal to what? To market value. It should be equal. Yeah, it should be equal. Market value should be equal to book value. But most of the time it is not. And it will rarely be. Rarely be. Yeah. Although management might be, although management might be accomplishing its objective by increasing the company's book value, this increase may not be reflected in market value because it does not affect investors' expectation about the company's future value, future cash flows. A key measure that investors use to evaluate the effectiveness of management in increasing company's book value is this. Sorry. So your accounting rate return on equity is what investors use to evaluate the effectiveness in the management in increasing book value. And that's what we have here, your ROE. This is your ROE. Yeah. So your ROE is what people or the markets use to judge how well you are doing. Yeah, which is this guy. So which is your net income divided by your average, your net income divided by your average book value, where your average book value is equals to your beginning book value plus your ending book value divided by 2. Yeah. So return on equity assumes that the net income produced in the current year is generated by the equity existing at the beginning of the year and any equity that was invested during the year. Note that some formulas only use shareholders' equity at the beginning as the denominator. Yeah, but it's best for you to use average for completeness. Yeah, okay. So one caveat to be aware when computing or analyzing ROE is that the net income and the book value of equity are directly affected by the management's choice of accounting methods. Very, very important. Such as those relating to depreciation, inventories. You've learned all these things in what? In FRE. So those are the things that affect your what? You have to be careful when you're using. Those are the things that you need to be careful when you are using what? ROE, because some companies might be dubious or might be using an interesting method or accounting method. Yeah. Okay. So book value, how well the company is making use of its equity from a book value perspective is what? Your ROE that we just discussed now. Yeah. Okay, moving on. So, little comments from the curriculum. ROE can increase if the net income increases faster than shareholders' equity, or if net income decreases at a lower rate than shareholders' equity. Makes a lot of sense. So how is your ROE? How is your ROE what? Increasing. Very important. How is your ROE increasing? How is the ROE of the company increasing over time? Very, very important. That also helps us to determine how the book value of equity is going to increase in the future. Yeah. An important question to ask is whether an increasing ROE is always good. The answer to that is it depends. One reason ROE can increase is if net income decreases at a slower rate than shareholders' equity, which is not a what? Positive sign. So you need to understand what is driving that increase. Is it as a result of increases in net income? In addition, ROE can increase if the company uses debt. Yeah, and I will explain that in a short while. If the company uses debt and then uses the proceeds to repurchase some of its shareholders' shares, his outstanding shares. So ROE can increase if the company uses debt. Have you guys heard of DuPont analysis? Have you heard of DuPont analysis? We're going to touch about that today, but you must have seen it in your, which is what it said here, DuPont analysis. That's one of the best. When I'm analyzing a company, that's one variable I like to use, DuPont analysis. So when your ROE is increasing, what is driving it? Is it as a result of increases in profit margin? Is it as a result of increases in efficiency, as a result of total asset turnover, or is it as a result of increases in what? In usage of debt? If it is increase as a result of debt, then we need to be worried. Yeah. But if it's as a result of these two, then fantastic. If it's as a result of debt, then you need to be very, 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 very worried. Yeah. So finally, the book value of the company's equity reflects the historical operating and financing decisions of the management. The market value of equity reflects, so book value is backward looking, while market value is what? Forward looking. So book value speaks about the potential of the company from a looking backwards, while market value is forward-looking, talking about the expectation, what the market expects from management, possibility of what future cash flows, the uncertainty that is tied to those future cash flows. Those are the, so what they're just trying to say is that you might look at the book value and see everything is being rosy. However, from a forward-looking perspective, you can see that everything doesn't look looks blurry. So those are the things that you need to consider when you are looking at book value and market value. So we've talked about intrinsic value before. Yeah. So intrinsic value is looking at the present value of future cash flows. Yeah. So forward to the present. Okay. Now let's move to cost of equity and investors' required rate of return. Now this is an interesting part that I like to speak about. Yeah. When companies issue debt or equity securities, there is a cost associated with this capital that is raised. For every capital that is raised, there is always a cost. When you raise debt, the cost of debt, there's always a cost, which is the cost of debt, which is the interest that the company will pay throughout the life of that debt. While when you raise equity, there's also what we call your cost of equity. Yeah, which is basically the cost which might be applicable to returns, might be applicable to dividends that the company is going to bear throughout the life of what? The capital that has been raised. In order to maximize profitability and shareholders' wealth, companies tend to raise capital efficiently so as to minimize these costs. When a company raises debt, the cost it incurs for the use of these funds is called the cost of debt. The cost of debt is relatively easy to estimate because it reflects periodic interest that the company is going to pay. When a company raises capital by issuing equity, the cost it incurs is called cost of equity. Unlike debt, however, the company is not contractually obligated to make any payment to the shareholders for the use of their funds. As a result, the cost of equity is more difficult to estimate. Investors require a return on the funds that they provide to the company. And this return is called the investor's minimum required rate of return. Yeah. When investors purchase the company's debt securities, their minimum required rate of return is the periodic interest that they receive. Because all bondholders receive the same periodic rate of return, their required rate of return is the same. Therefore, the company's cost of debt and the investor's minimum required return for debt are the same. However, for equity, they are not the same. When investors purchase the company's equity securities, their minimum required rate of return is based on the future cash flows they expect to receive. Because these future cash flows are both uncertain and unknown, the investor's minimum required rate of return must be estimated. In addition, the minimum required return may differ across investors based on their expectation about the company's future cash flows. People are forecasting these cash flows differently. They are looking at it. Remember when I taught you guys efficient market hypothesis? Yeah, efficient market hypothesis. When I taught you the last class, I said intrinsic value. People are talking about their intrinsic value differently. They see things differently. So as a result, their required rate of return are different. Because companies try to raise capital at the lowest possible cost, the company's cost of equity is often used as a proxy for the investor's minimum required rate of return. Yeah. In other words, this is what I'm going to read last. Apologies, I'm reading out from the curriculum. In other words, the cost of equity can be thought of as the minimum expected rate of return that the company must offer its investors to purchase its shares in the primary market and to maintain its share price in the secondary market. If this expected rate of return is not maintained in the secondary market, then the share price will adjust so that it meets the minimum required rate of return demanded by investors. For example, if investors require a higher rate of return on equity than the company's cost of equity, they would sell their shares and invest these funds elsewhere, resulting in a decline in the share price. As the share price declines, the cost of equity would increase to reach the higher return on equity that investors require. Now, what are we saying here? What we're saying here in a nutshell is, let's use this as return, minimum return. Let's use that as KD. Naturally, this should be the same. Yeah. While this is based on what? This is based on future cash flows. The uncertainty of future cash flows. Now, at every point in time, a company would naturally use its debt, its dividends, as a means of what we call signaling, and as a means of that cost of equity that investors need. But the company itself does not even know what shareholders want as cost of equity. Yeah, or what we call, another way to look at it is dividend yield. In simple terms, dividend yield. So we don't know what level of dividend yield would make investors happy. Yeah. So at every point in time, the company is always what we call signaling, such that the company will pay dividends and see the way the market will react to that dividend. Because if the market is excited about that dividend, then it means that at that point in time, your rate, the investor's rate of return was less than the dividend yield. And let's just assume that this dividend yield is equals to what? The cost of equity. Yeah. And in a situation where they pay dividends and the market declines, then it means that at that point, the minimum required rate of return was greater than what the dividend yield is, which is your cost of equity. So what would the company do? Maybe at the next dividend payment, they might want to increase it to see how the market reacts to it. So the fact is that nobody, for one, knows what the cost of equity is. Even the company doesn't know what the cost of equity is. And nobody knows what the minimum required rate of return investors want, because investors are diverse. But what the company needs to do is just to look for how to satisfy a selected few and believe that that selected few is the larger group, such that if I can satisfy this selected group, the price of my company will continue to what? Will continue to rise. So I continue to deliver dividends that leads to price appreciation. And I assume that that dividend is is my cost of equity, even though I'm not meant to pay cost of equity. So a company that doesn't pay dividends, how does the company know the required rate of return? The way the company will know the required rate of return is to look for other means, as a means of what? Signaling to the company to say, we are a company of what? Of value. So that's the issue with what? With cost of equity and minimum required rate of return for equity investors. It's always a tough one to sort of navigate in identifying what that actual one is. And with these few points of mine, we have come to the end of this particular reading. Do we have any questions? Any questions?
Yeah, you're welcome.
Fantastic. Okay, so let's quickly look at this reading, and we call it a fantastic Sunday. So this reading looks at company analysis, yeah, and the curriculum is trying to present a flow that I like. So the curriculum has told you about, last reading has told you about common shares. I've told you about the essence of common shares. I've told you about the investment characteristics of common shares. And as told you that there's something called market value and book value. Book value is driven from the company's financial statement, and talks about the past performance of the company, while the market value is driven by intrinsic value that is based on the present value of future cash flows and the future risks that uncertainty of cash flows that investors perceive are attributable to that company. Now, the company is saying, okay, let's teach you how to value a company. Yeah. And how do you value a company? So so what we're getting here now is we're looking at the flow. So first thing first, in order for us to value a company, we need to carry out what we call company analysis. Yeah, to look at past and present, understand the past performance of the company and the present performance of the company. Interestingly, everything that you're going to see here are things that you probably would have seen in your FRA. Yeah. So the LOS says describe the elements that should be covered in a thorough company's research report. Determine a company's business model. Evaluate a company's revenue and revenue drivers, including pricing power. Evaluate a company's operating profitability and working capital using key measures. Evaluate a company's capital investment and capital structure. And when I read this reading is actually new. It wasn't here before. When I read it, it was quite interesting. Now, what are we trying to do here? We're trying to. You guys must have heard of companies' research report. So there are some organizations that they provide research reports of companies so that you can better understand this company. Yeah. And the research report will have different aspects. We'll have content that sort of puts more information about the company out there. Yeah. So basically, when you are looking at a company's research report, has been provided by a most likely organization, you can adequately understand what the information in that report is saying. Yeah. So they say this module is the first of 3 that will provide a framework to prepare a company research report by applying methods covered in the previous modules to assess a company's business model, financial performance, and financial position. So there are 3 things we're looking at here: your business model, your financial position, and your financial performance. So the whole essence is for us to better understand a company. Yeah. There are a lot of boxes in this reading. The learning module overview, learning module self-assessment, and all that. But let's jump all that and sort of move more into. So, what are company research reports? Yeah, describe the elements that should be covered in a thorough company's research report. Like I said, a research report is a report that's been provided by an investment firm that sort of provides more information about an organization or a company. And it goes ahead beyond just providing information to sort of providing what we call an investment recommendation, to sort of, based on the information that they've gathered, they can end this report by telling you to either buy this stock, sell this stock, or hold this stock. And that's basically what the research team of an organization or of an investment firm should be making available to either clients, investors, or their portfolio managers, depending on which side you sit on. Yeah. So an analyst value and make investment recommendation on issuers' equity securities using scenarios of future earnings, cash flows, and financial position. Yeah, so the curriculum says that this research report is more around the analyst views and is based on how the analysts gathers information, analyzes this information, and sets its views around the information that has been gathered. And one thing I always tell people is you appreciate that this is either an organization or an individual's view about the company that not necessarily have to align with your own views. There might be some common factors, and there will be a lot of uncommon factors. Now, the process of forming and justifying a view of an issuer's future financial results and position involves company and industry analysis, and is the subject of this module and the next two. Yeah. So we're going to start with this today, and in the next class, most likely next week, we're going to focus on the other two, such that after that, we're going to have one more class where we would wrap up equity investment. So the exhibit below introduces this framework for company and industry analysis. Very, very detailed and interesting framework. And this is the framework, which is your exhibit 1. And it says that the pyramid starts from the base, which is your company analysis, and past, present, which is what we're doing here. Industry and competitive analysis, which is what we're doing next week. And company analysis, forecasting, which is what I'm also going to do next week. So the company analysis past and present comprises of 4 things: identifying or determining the company's business model, analyzing the company's revenue and revenue drivers, analyzing operating profitability and working capital, and analyzing the company's investment and capital structure. Now, the industry analysis goes into to identify an industry, analyze the size, growth, characteristics, profitability, and market share trends in that industry, then evaluate the company's competitive strategy and positioning, and determine if the company has a competitive advantage in that industry. So because you know the company, you know how the company generates revenue, you know the company's business model, you know the company's profitability and all that, you now look at the company in comparison to its peers, identifying its peers and comparing that company to its peers, and you making a conclusion to see if the company is better than its peers or not. That is number 2. Then number 3 is we're now going to forecast. Now that we have all this information, we now want to forecast. So we have to determine the forecast objectives and approach. We have to look at the forecast revenue. We have to forecast operating profitability and working capital. We have to forecast capital investment and capital structure. Then evaluate key risks and uncertainty. So basically saying our understanding of what we have here, we now take it into this future, into this box, but with arming ourselves with the understanding of what we know about the company in this box. Now, analysts present their company and industry analysis as well as their valuation and investment recommendation in a company's research report. Yeah, the structure, content, and tone of the report depends on the analyst setting. Like I said, it's all dependent on the analyst. It's the analyst view, analyst work. If we look at it from an example of a sell-side report where a public issuers equity securities for distribution to external, or you can look at it from a buy side where, like I said, a research guy is advising or providing out information to his portfolio managers. So an example of a structure. So we have 2 types of reports. We have the initial company report and the subsequent report. So an example of the structure of an initial company research report for external distribution is provided in Exhibit 2. The primary audience is those who are not already knowledgeable about the issuer and the security, meaning that the company is coming to the market for the first time, and your expectation is that maybe the company is doing an IPO. So the expectation that people don't really know about this company. So a typical example is Transcorp. Yeah, Transcorp Power. Fine, a lot of people have heard of Transcorp Power, but nobody has actually ever done a research report on Transcorp Power. So the point that the company was getting listed on the exchange, a lot of companies issued what we call the initial company research report, that to sort of create a form at which the market is going to understand this company. And from there, they start to issue subsequent reports with the expectation that a lot of people have read the initial reports. Now, what's the structure of the initial company report? We have the first part, which is the front matter, which comprises of the issuer's name, his identifier, the analyst's recommendation, and the disclosure, disclaimers, and other legally required information. Yeah. Then you have the recommendation. So the analyst recommendation, summary of key reasons supporting this recommendation. This is like the most important aspect of you reading this report. Now, we now dive into the company's description. Yeah, what is the company's business model and strategy, which is what we're talking about now. Then if you have any charts that talks about the products, the revenue, and all that. So these are basically two things that we're going to be focusing on today. Then we now look at what the industry overview and competitive positioning, part of what we're going to look at next week. So what industry is the company in? What is the industry size? What is their growth rate? Is there any market share trends? Then what is, Porter's 5 forces? What is the competitive analysis, in terms of his peers? Then analysis of external industry influencers. Then this is where you use your pistol. Yeah. Then evaluation of the company's position and strategy in the company. Does he have a competitive advantage? Is he a market leader? Is he a laggard? And all that. You get all that. Now we move to the financial analysis, where you punch the numbers, where all the things you learn in FRA kicks in. Yeah. So evaluation of key drivers of revenue, profitability, forecast of key drivers of supporting your decision, historical financial statement. Then your evaluation kicks in. What valuation methodology are you using? Then typically includes relative and present value approaches. Then ESG has become a very key aspect in valuation. What are the evaluation of the ESG indicators and risks? Then what are the risks that investors should consider when they are looking at this company? Yeah. So, for example, the curriculum is saying that you can also go and check their website for, there's something we call the CFA Institute Research Challenge. Apparently, university is done by universities. University of Lagos got to the final, but I have a feeling that they did not win. Okay, that's EME final. Europe and Emerging Africa. Yeah. Okay, Europe, Middle East, and Emerging Africa. I think so. Anyway, now, after you have done the initial report, then your subsequent company research reports are often shorter than initial reports. So that first one is more encompassing, but this one, we already know who the company is and all that. So what you're going to be having there is you're jumping straight into your recommendation, your valuation, and your risk. So company description and all those things are taken out because you already know the company. Yeah. So we're going straight to your recommendation. You're going straight to your analysis of new information. So what are the new information that is making you to make this recommendation? Then how does it affect your valuation? Then what are the risks that people should consider when you are considering this company or considering your recommendation? Yeah. So this is going to be a very fast reading. I don't think it's a very long one. Okay. So breaking it down, remember I told you that for this reading, we're going to be focusing on determining business model, revenue drivers, profitability, operational profitability and working capital, then capital structure. Now let's move to determining business model. So determining the business model is the first step in this framework. You need to understand the company's business model. You need to understand what the company is doing. Yeah. So recall that a business model describes a company's operations and includes the following elements, which analysts investigate by answering several questions. So we need to know what you are doing. How do you generate money? So let's even start by saying not even how you generate revenue. What do you do as a company? Yeah. What are your products? How do you sell your products? Who are your customers? Yeah, who are you pushing this product to? Who are you pushing this service to? You understand? When you wake up, when your staff wake up every day, what are they doing? Are you a manufacturing company? Are you a service company? Do you generate products? Do you provide services? So what is the essence of your organization's existence? That is what we mean by business model. Yeah, how do you operate? So those are the questions that you naturally ask. What is the firm selling? To whom are you selling? What's your target market? Yeah. How does the company reach? How do you push your products? How do you push your services? Yeah. How do you operate? Yeah. How does the company charge, and how are the prices and payment terms structured? How do you generate your revenue? What prices do people pay you for your services? Is it as a percentage of AUM? Is it a percentage, or is it per hour? Is it by number of staff? Is it a one-off fee? How do you come about these fees? And what does the company buy and rely on? Yeah. So when you look at each of these questions, it sort of forms the basics to your business model elements, your products and your services, your customers and your key customer groups, your sales channel. Are you an e-commerce company? Are you a direct? Do you do delivery? Yeah. So I'll give you guys an example. So I have a friend. He has a laundry business. And one day we're speaking, and I told him, why is he always the one that does pick up and drop off of his customers' clothes? Yeah. And he said, oh, that's because, and I said, why don't you consider using a delivery firm? So engage a delivery firm. The delivery firm will give you most likely like a bike guy or something that, they come and pick up your clothes, drop off, and the guy is working directly with you. Yeah. And the guy said, oh, that will incur cost. And I said, then put the cost into your pricing and let your customers know that this is, for efficiency, because for one, you are picking up a car, you are driving around the old Lagos, dropping people's clothes, stressing yourself out, and all that. So, like I said, how do you reach your clients? What's your sales channel? How do you deliver? What's your product and service delivery mechanism? Yeah. Then how does the product and how are the services and products priced? And what are they priced for? Yeah. Then who are your suppliers? Who are your partners? Where do you get your raw materials from? Where do you get your sources, your resources for the business? Where do you get it from? So those are the things that form your business, So these are the information sources. Yeah, there are many corollary questions for each of these questions, such as determining whether customers are few or concentrated, whether suppliers and resources are specialized or add to place, and so on. The answers to these questions are company specific, but the key questions to ask are common across industries and companies. Yeah. So what they're trying to say is that these questions are the same across industry. However, the answers that you get, for each of these questions, you see that there are different answers based on even companies within the same industry. Yeah. Analysts will often focus their analysis on the differences in a company's business model, if any, from a conventional model or those of its competitors. So you are also doing business development, business model analysis, business model competitive analysis. two people say they are both in the asset management space, but by the time you ask them all these questions, you realize that their answers are different. Then you start to wonder, okay, what do I understand naturally as an asset management business, and how are these companies different from the standard that I expect? You are getting my point. Then you start ask yourself questions around the fact that this guy is deviating from the norm. Is he adding value to the business? Is it what is making this company stronger? Is this what is making this company what it is today? Or is it why it is affecting the company negatively? So those are the kind of analysis you do from a business model perspective. So information sources that analysts use to answer these questions include the following. So at times you might not be able to meet the owners of the business particularly to answer questions, but you can also get this information from different places: regulatory filing, from their financial statements, from by talking to the company directly, third-party research information, press release, all over the whole place. Information. If I ask you guys now to come to me next week with the business model of Transcorp Power, I'm sure a lot of you would get that information without having to call somebody in Transcorp Power to ask the person, please tell me about your company. This information is all over the place. Yeah. Okay, moving forward. Yeah. So there are different places you can source for this information. We will demonstrate the determination of the issuer's business model with a fictional example adapted from a real company. We will use this case study throughout this model and the next two models to demonstrate the use of the company. Yeah. So, and the company's name is Warehouse Club in Sync. Yeah. So let me just read. It's a lot of read, but you can read it at your own time. But it just gives you a brief about what this company on Warehouse Club is about. Yeah. So Warehouse Club is a public company, and all that. I sort of read it, but I didn't really go into detail. Yeah. So Warehouse Club is a leading discount retailer consistently offering customers more than 20% savings on a broad range of food and other merchandise, compared to supermarket and departmental stores, convenience stores, and income. Warehouse Club operated 194, 149, 145, and 141 stores as of 2019, 2028, and 2017, respectively. So yeah, you can read it. It's a discount company that offers discount. Yeah, okay. So it's like I said, it's a long one. Yeah, but this is a very short read. So you can read that at your own time when you are reading the curriculum. Yeah, but that's basically everything on business model. Yeah, so business model is just understanding the basics. What does the company do? How does the company operate? What products and services does it offer? Who are its target market? How does it price within that market? Then where does it source? Where does it get its resources from? So so that at least So what has happened there is, remember that a company must. So let's look at a typical simple company. Yeah, let's say a company that buys and sells cars. Yeah. So first thing first is that is what the company is about: buys and sells cars. So its product is selling of cars. Who are its target market? So the guy sells cars to, say, luxury cars, so high-end cars to big boys and all that. So he has been able to reach out to some companies to be able to engage these companies to say, okay, if your CEOs or your top management staff want luxury cars, you can buy them from us. So that's his target market. Yeah. So where does he source these cars from? Oh, he sources these cars from America. He has probably an agent in America that sort of looks around for these cars, gets the best cars, and ship them down to Nigeria. So basically, you can see from one side to say, okay, This is where it gets its cars from. This is where it sells its cars to. What it does is selling of cars. These are the people that it sells its cars to. How does it price the cars based on based on market value, considering the fact that he has one of the top cars. Yeah, so that's basically business model in a nutshell. Now we are now moving to the next one, which is revenue analysis. Yeah. So first thing first, what are the revenue drivers? What are the things that drive your revenue? Yeah. So after determining the business model, we turn to the analysis of historical financial results and the position of the company. This analysis will be used as the basis for forecasting a financial statement model that supports security valuation. For most of companies, perhaps with the exception of banks, for which the balance sheet comes, analysts starts from analyzing revenue. So for banks, we don't analyze revenue. We analyze your balance sheet first. But for most companies, we start from your revenue. What is the number of your products you sell in a year? At what price did you sell them in a year? Automatically, that leads to our revenue. So what are the two things that drive our revenue? Number of goods sold and the prices of goods. What factors affect the number of goods sold? What factors affect your revenue or your price? Are the two things that determine our revenue drivers. So as with other financial statement lines, the analysis involves identifying drivers, which are the causative factors that explain the level of changes in an output variable, and understanding the evolution of the drivers over time. So you can either do a bottom-up approach or a top-down approach. The bottom-up approach decomposes revenue into drivers such as sales volume and price, revenue per product, segment, geography, all just starting from the basics, which is what is your volume, what is your price, what are the factors driving your volume, where are your volume being gotten from? Are you selling in Abuja? Are you selling in Lagos, Port Harcourt? Are you selling in Kano, Kaduna, spread across the different states? Which state is driving, gives you the highest volume? Are your prices equal across each of these states? Okay, which one do you have the higher price? Which one do you have the lowest price? Why do you have the higher price there? Why do you have the lowest price there? Those are the things that we sort of use to dissect your revenue. Yeah. However, that's bottom up. However, for the top-down approach, we start from the economy, we start from impacts in the market, so the top-down approach expresses revenue as a function of your market share, the economy, your market, the industry, your market share in that industry, your size in that market, and GDP growth and all that. So that's the top-down approach versus the bottom-up approach. And the curriculum for that goes deep into the case analysis to sort of expatiate on what top-down approach. But what I like what they've done here. So they've looked at it from the number of stores that they have, the number of stores. So for this company, what drives their revenue is the number of stores that they have, because that's what they use to reach their final consumers. So what they did was, what are the number of stores that they had at the beginning? What are the stores that they had during the year? What is the average store at the end of the year? Then what is the net sales per store? Yeah. Then with that, they can use that to know what their net sales are. Do you get? So basically, what you're saying here is what drives their net sales is really based on what the number of stores that they have. So it's not really by price, but the number of stores. So you need to be able to identify what the company's revenue and break it down to, that's the bottom up actually, break it down to volume versus price. What drives volume? Understand the factors and variables that drive volume, and be able to break that down to get to the last minimum, where you can now see everything that drives volume. Yeah. And if you can do that for also price, to say, okay, price is driven by, let's say, is a fuel station, is driven by the government. What is the possibility that government is going to increase prices and all those things? Or how has government increased prices in the past versus how government will increase prices in the future and all that. So yeah, so that's your revenue and your drivers analysis. Yeah. So you can see what the curriculum started from was looking at it from this, which is more looking at it from a volume perspective. Yeah. They also said another thing again that drives, I'm just using this company again as an example. Number of people again that drives is what? The number of members that they have. So they have a structure which is why it's called warehouse club. Yeah. So they have a structure where it's based on is membership. Yeah. So the more members that they have, the more they can drive. That's why so the company is a discount. It's like a discounting company. So if you're a member, you come into their store to buy things at a steep discount. Yeah. So two things that drives their revenue, their volumes, is the number of stores that they have and the number of members that they have. Yeah. So if we have more members, we know that obviously there will be more demand for our goods and there will be more people patronizing us. If we have more stores, we will to reach more people, more members, because obviously it's a physical store. There's no online. So the more stores you have, the more people can walk in and buy stuff from you at discounted prices. Yeah. So that's why they have what? Members, and they have stores. They've been able to break that down. Yeah. Then we now have where we talk about price, which is where I talk about pricing. You have to also look at the variable of price, because price also leads to revenue. So prices are a driver of revenue for every firm. And it may appear that pricing is a unilateral decision by management. Yeah, not necessarily. In fact, prices are constrained by the company's pricing power. So I'll explain what I mean by pricing power. So it's a battle between the company and its customers. And I'll use that, my friend, as an example. So my friend, I told you that laundry business, he drives around, does pickup, does delivery by himself. He has a bunch of guys that do the laundry. He has a nice, well-kitted laundry mat, and all that, and laundry shop and all that. But I was of the opinion that, why are you the one doing this? Why don't you get a delivery guy or get a delivery person to be doing all this for you? And the end of this conversation was price. And in his own words, he doesn't have pricing power, meaning that if he pushes the price, because I told him that push the price of this delivery to your guys, to the customers. You are getting my point. If you are doing a fantastic job, these guys will not bother about you increasing price and you telling them that the reason why you're increasing price is because of efficient delivery. Because most times he will call me and say, are you at home? I'm not home. And obviously, because I'm not home, he can't pick up clothes. He cannot deliver. So if there's a delivery company and you've made them know that, the delivery guy will be coming at X time during the day, the guy can even put his clothes somewhere to say, okay, every time you come, the clothes will be in this basket, pick up the bag and go and do my wash. And every time you want to deliver, come back and put it back in this same spot where I will sit. I don't have to be at home. Yeah. And his issue was really around price, meaning that, it will be expensive. He will not be able to bear the cost. And I said, push it to your client. And he said, my client that if I increase laundry money a bit like this, all of them will run. Yeah. And he also comes with your competition. So in his own words, there are a lot of people out there, they can decide to change their mind and say they're not giving him clothes again, and they want to give the clothes to the next person that is giving them cheaper price. So that is where your pricing power. So in the essence, that guy does not have the pricing power. His clients actually have the pricing power. So those are the things that you need to consider. A typical example is they've increased electricity tariff for band A. Band A guys cannot run away because the reason why they can't run away is they need the light. So they don't have, so at that point, the discos have power over customers because it's either you pay or you don't pay. If you don't pay, you don't have light. And the next substitute you have is more expensive, which is to go and buy diesel, which is more expensive. So if you think about it, I don't have a choice. I have to do it. The only thing here is that you guys must give me what? You must give me consistent light. So Pricing power is also very, 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 very key. The reason why the discos have not increased electricity light is because their regulator has been clamping down on them all these years. I can bet with you that if the regulator wasn't clamping down on them, the prices of the electricity would have skyrocketed in like gazillion years ago, since they did that, since they did the privatization of those discos. So in most, so like I said, another thing again is competition. Yeah. So competition has a way of if affecting pricing power. So in most competitive markets where firms are selling nearly identical products, firms are price takers. That is what is happening in the downstream force stations. That is, price is dictated by the forces of demand and supply. And all firms generally sell at the same price, which is what happens in your almost everybody selling fuel at the same price. I can imagine if they fully deregulate, a guy that sells maybe 0.5, a guy that sells maybe 5 kobo different from another person is where everybody go and pile up. Yeah, but in this case, you see queues on NNPC fuel stations because NNPC fuel stations are selling significantly lower than other guys, and they can bear that cost. Yeah, if a firm prices above the prevailing market, it will sell a fraction on none of its output. That's it. So, if there were a lot of NNPC fuel stations, you will see that nobody will be going to Mobi, Pinnacle, all those Wando, all those fuel stations. Everybody will go to NNPC. But because there's not a lot of NNPC fuel stations, so people go, I beg, it's not 29. Let me enter mobile and buy fuel and move. Yeah. So that's what they're trying to say, that if you're in that kind of market price, which is what my friend is also experiencing, that laundry business, there are a lot of people that are doing it. If I just increase price small, like this, all these guys will pack their load and move somewhere else, which is where service delivery comes into play. Yeah, so you have to know what your strategy is. If you are delivering optimal service, even if you increase price, people will be quite reluctant to move away. Yeah. So where were we? It is also generally not rational for a firm to price below the market price, as doing so would not only reduce its profits, but also cause competition to do the same. Yeah, so leading to a price war. So if you cut prices, people too will follow. No doubt about that. Yeah, so there's really no point. Yeah, but so return on capital is highly competitive. In highly competitive markets, move in cycles because of demand and supply. But over the long run, approximate firms' cost of capital as competition forces prices down to a marginal cost. A low-cost producer, yes, which is another guy that you need to be careful about. A low-cost producer can, however, earn long-run returns above its cost of capital in a highly competitive industry, but it requires the lowest cost position to be sustained against competition over time. So GTB was moving with the strategy of low cost versus Zenith Bank. So if you notice, if you entered back then, if you entered, I think it even still happens now. If you enter GTB branch, is HND and OND and contract staff that you see everywhere. But in Zenith Bank, you can even see a senior manager in the branch. Trust me, you see a assistant manager in the branch. Sorry, not senior manager, assistant manager. You see him at the branch as teller. So GTB was running at low cost compared to Zenith, but I hope that is still the same until they now moved into technology, and that their technology has been messing them up of late. Yeah, so you need to be wary of these guys. Yeah, very, very wary. So yes, so competition is what drives this industry in terms of price. So when you're thinking about price power, you need to think about competition. You need to look at it from an industry perspective and from a customer's perspective, two working hand in hand. in the sense that in a case where things are not going well, I'm sorry, if you move your price, competitor can move to a competitor. But in a market that's not that competitive, you can increase price at will because the customer knows that there's no point. It is only you that is going to face. Yeah. Okay. So moving on. So analysts evaluate pricing power not just by examining a firm's price over time or relative to its competitors, but also, so this is very, very, very key. So also by comparing a firm's price with its costs in order to what? In other words, its profit margin. So if the cost of production is high, yeah, and price is almost close to cost of production, then that guy might be having issues with price wars or pricing power. So if he tries to reduce price in order to drive on quantity and quantity doesn't come, he might be shooting himself in the leg. So those are the kind of analysis that you need to be looking at when you're doing your pricing power. How easily can the company How easily can the company adjust its prices? So that's where elasticity of demand comes into play. If you can remember economics 101. Yeah. Now, top-down revenue analysis. Remember I told you that there's the bottom up and the top down. So bottom up is where you identify all the drivers of revenue and you sort of deal down. Yeah. But for top down, you're looking at it from the economy, the industry, the market share. What is the market share trends, and all that. So analysts can also take a top-down approach in analyzing revenue by expressing it as a function of drivers such as the market size, the company's market share. Yeah. So how has market size grown over the years? How has market share? How has the industry size grown over the years? What is the company's percentage of that market share, of that market size? You're getting my point. So if the market size is, say, 10 million and it's growing by, say, 30% every year, and the guy owns 30% of that market share, so that means his own market share is 3 million naira. So it's 3 million. So you can assume that his own too will be growing at 30%. So that's top down. So looking at it from the top. Yeah, not so much of an interesting way I prefer the bottom up. When it comes to revenue, I prefer the bottom up, looking at it from revenue multiplied by price, than looking at it from market share, because market share at times doesn't stay stagnant for a very long time. This approach will be discussed in more detail in the next module, yeah, under industry and competitive analysis, because that's where it makes a lot of sense, to be honest. Yeah. Okay, moving on. Like I said, this reading is not going to take so much of our time. Now, let's move to operating profitability and working capital analysis. So we have done business model. We have looked at how the company's revenue trends are. What is driving the revenue? Yeah, in terms of volume and price. We looked at what are the volume drivers. Yeah, and what is the price drivers, and how does that link to your revenue? Yeah. We've done those two. Now we're looking at operating profit. Yeah, operating profit and working capital. Yeah. So your operating cost, you need to understand the operating cost, because operating cost less from revenue gives you your profit. Yeah. So you need to understand your operating cost. Generally, operating costs are incurred in generating or otherwise related to the current period's revenue. So what are the costs that you incurred in order to be able to deliver that revenue that you have today? All costs related to the acquisition, production, sale, improvement, delivery of goods and services, management of business activities, and compliance with law and regulation. Investing costs are related to acquisition and production of long-term, which is not necessarily part of your operating cost. So your investing cost is things that have to do with property acquisition. Those are things that you see in your cash flow statement. Yeah. Then financing costs are also part of what you see in your cash flow of your statement. So we are paying interest, we are paying dividends and all that, that has to do with return on investment. Yeah. So to the people that provided you capital. Yeah. So you need to understand the various costs. So if you can see, research and development is investing. Yeah. The depreciation is actually also investing. Well, anyway, let's move on. Yeah. For most companies, operating costs account for the majority of the costs and are primarily determined by the company's business model and size. Very key. Very, very key. Yeah. So for as shown in Exhibit 4, a company's operating costs can be categorized and analyzed in 3 ways: by their behavior with output, their nature, and their function. So behavior with output, variable and fixed. Nature, compensation, raw materials, merchandise, office. Function, cost of goods sold, sales and marketing, general administration, research, and development. So let's talk about fixed and variable costs. Yeah. A useful classification of operating costs for analysts is fixed versus variable, which are introduced in an earlier model. So that means you must have learnt it in probably corporate finance or something. The distinction is useful because the proportion of the fixed to variable in operating costs affects the stability and predictability of profit. So if you have more fixed costs, it's easy for me to be able to project. But if you have more variable costs, it becomes a bit shaky for me to be able to forecast your future profits. So using a fixed and variable cost operating cost classification, operating cost is defined in equation 1. So operating profit. Apologies, this is your operating profit. So operating profit is your price minus variable cost multiplied by quantity minus fixed cost. Yeah. Like I said, you've done that in your corporate finance, yeah, which is corporate issuance. Yeah. Then we have your operating leverage, can be measured and compared across firms by using the degree of operating leverage, which is the change in operating profit divided by percentage change in operating profit divided by percentage change in sales. That helps you to know your degree of operating leverage. A firm can increase its degree of operating leverage by increasing its fixed cost and decreasing its variable cost in its cost base. Like I said, the problem is what is variable cost. Recall that the amount of fixed cost in an operating cost structure of an issuer is referred to as the operating leverage, and that is present that it presents both benefits and risk. If operating costs are largely fixed and the contribution margin is positive, operating profits can increase rapidly with increasing in quantity. So this is the key part. So what we're saying here is everything here. Let me just highlight everything here. So if your operating costs are largely fixed costs and the contribution margin is positive, meaning that this is positive, yeah, operating profits can increase rapidly with increase in quantity. However, the reverse is true if quantity declines, since fixed costs do not change, so operating profit will fall, as shown in equation 2 below. Yeah. So what I'm just trying to say here is your degree of leverage shows how your sales flows into your operating profit. So the larger your degree of financial leverage, the more your sales will flow to operating profit. And your degree of financial leverage is higher if you have more fixed costs than variable costs. Yeah. Okay. So moving on, like I said, this material has a lot of examples that you can look at. Now, the next is natural and functional operating cost classification and the measures of operating profitability. Yeah. Rather than fixed and variable costs, IFRS and US GAAP requires issuers to disclose operating costs using either a natural or a functional cost classification based on historical and industry factors and the nature of the entity. Most issuers, including warehouse, choose a functional classification. It's mostly functional that people use. So that's this approach leads to all issuers' income statements appearing similar in structure, with lines relating to function areas such as cost of sales, sales and general administrative expenses, research and development, finance cost, interest cost, and all those things. Yeah. So why is this thing moving slowly? So measures of operating profitability. So your measure of operating profitability comes from different angles. You first have your gross profit, then you have your EBITDA, and you have your operating profit. So EBITDA is your earnings before interest and tax, depreciation and expenses, meaning that you are just subtracting cost of sales and operating expenses while without taking cognitions of depreciation and amortization. But when you bring in depreciation and amortization, you now have your operating profit margin or EBIT margin. I know you guys know all this. This is FRA. Yeah. As so I like this paragraph. Apologies if you just allow me to read it out. It's kind of an interesting one. So for most companies, the major driver of operating costs over the long run is output, even for fixed costs, because output growth often requires growth in assets, human capital, and purchase goods and services. For the warehouse club, for example, might be able to grow membership fees revenue to an extent without incurring cost, but growing net sales requires more stores and employees. This may be true even for so-called asset-light companies in the internet and software industry, which have shown large increases in operating costs along with large increases in revenue over time. Since output or revenue is a major cost driver, analysts often express operating costs as a percentage of revenue. Yes, we do that a lot. Operating costs as a percentage of revenue. Additional considerations include industry profitability, economics of scale, and economics of scope. Yeah. So that's operating profitability. So it's either you state it from, so rather you state it from a profit margin perspective, you can state it from a operating cost to revenue perspective. Yeah. Which is just the opposite of the other guy. Yeah. So moving on, your working capital, liquidity. So we've looked at degree of leverage, looking at it from fixed cost and variable cost. Now we're looking at it from working capital perspective. Yeah. Recall from earlier modules, like I said, corporate issuers. Yeah. That the primary measure of corporate's working capital management are activity ratios that determine its cash conversion cycle and the ratio of net working capital to sales. Yeah. So these are the things that you are looking at. You are looking at activity ratios, cash conversion cycle. I love that a lot. For me personally, I'm very big on cash conversion cycle. How fast does the company convert its assets to cash? Yeah, from buying inventory to producing the product to selling the product and receiving cash. That is your cash conversion cycle. Yeah, or the ratio of net working capital to sales. A short cash conversion cycle means that the company requires less external financing to fund operations. Yeah. And for me, when I'm doing my comparison across companies, I always look for that company that has the shortest cash conversion cycle. Yeah. And if that cash conversion cycle is in line with my own, what's that word? In line with my own funding needs. Yeah. While net working capital requirements determine a minimum level of investment in addition to capital investment that cannot be distributed to investors. Negative net working capital means that suppliers are a source of financing. Suppliers are a source of financing. You guys know all these things from FRA and corporate issuers. Yeah. So you can sort of look through this. It's an interesting one. I like the flow that the curriculum did. You can look at it at your spare time or when you're reading, but basically that's it. So when you are forecasting, all these things I'm saying would sort of form base in the last part to say when we're forecasting, we need to be able to forecast the company's revenue. We need to be able to determine the company's either forecast-based company's profitability, either forecasted from a profit margin perspective or from a operating cost to revenue perspective. We should be able to also forecast the company's net working capital, yeah, or the company's cash conversion cycle. But most of the time, we always use net working capital. So the net working capital is always also very good because we need that in order to determine our free cash flow to the firm. So when you are forecasting your free cash flow to the firm, those are the variables that comes into play. So like I said, all these things would sort of form base when we start to forecast. But remember that this reading is past and present. So we need to know what happened in the past and what is currently happening now for each of these variables in order for us to be able to forecast what's going to happen in the future. Yeah. Okay. Okay, so to the last part of it, we have capital investment and capital structure. Yeah, sources and uses of capital. Yeah, sources and uses of capital. So where does the company get its capital from, and what is he using? Which of this is he using more of debt or is he using more of equity? And what does he use his capital for? So firms invest capital from debt and equity investors to earn returns above their investors' required rate of return. An important consideration in company analysis is to evaluate whether required rates of return have been met or exceeded, whether economic value is created for investors over the long run, and to assess risks and opportunities associated with the capital structure, such as the use of financial leverage. Like I said, corporate issuers, yet again, degree of financial leverage. Yeah. So when you talk about operating, you have degree of operating leverage, then we have degree of financial leverage. Yeah. So these are the sources of capital and these are the uses of capital. So cash flow from operations, including net working capital, uses for cash and investment on hand. Then you have debt issuance, equity issuance, asset disposal. Yeah, some people actually create cash capital by selling their assets, disposing the asset that they don't need. Then you have the net working capital, if positive, capital expenditures and additions to intangibles. Some people use it to acquire, some people use it to pay down debt, some people use this capital to also what? Pay dividends and do share repurchases. Yeah, so you need to understand the organization from this perspective. Where is he raising majority of his capital from? what source is he using to raise capital, and how does he make use of that capital? Is he paying more of dividends with it? Is he paying down? Is he acquiring? Is he buying intangibles? Is he expanding? Is net working capital positive? We don't like negative net working capital, and all that. Yeah. So they use back to that case analysis to identify that for the company. Then they are saying, how do you evaluate? You use the degree of financial leverage to evaluate. So returns on investment capital over the long run compared with investors' required rate of return. I've explained that to you guys just in the last reading. Can be used to evaluate whether management has used investors' capital wisely. Recall that the independent investment analysts do not have access to the same information that the management uses to assess individual projects with IRRs and NPVs. So analysts have to use more aggregated measures to discern whether there has been worsening or improving trends in value creation. Risk related to capital structure can be measured using leverage and coverage ratios. Credit rating by third-party rating agencies and the sensitivity of net income to changes in operating income, known as degree of financial leverage. As shown in equation 3, the degree of financial leverage is increased by higher interest expenses that are fixed with respect to operating income. The degree of financial leverage is analogous to the degree of operating leverage, but is determined by financing costs rather than fixed operating costs. This is your degree so your degree of financial leverage is equals to percentage change in net income divided by percentage change in operating income. Yeah, the higher the degree of financial leverage, the more operating income tends to flow to net income. Yeah. So right. So they've also used that guys reading, and that's where we have your. So remember when I said DuPont analysis? So this is DuPont analysis. Yeah. So your DuPont analysis is you decompose your ROE to profit margin, asset turnover, and equity multiplier. I'm always very particular about this guy. Company that is increasing this will technically increase this, but these two guys are the important guys. That means that guy is just borrowing, but that borrowing is not leading to profitability or is not increasing his efficiency. So where is that money actually going to? You find out that the guy is probably using it to pay debt or something. Yeah. So unlevered returns as measured by your ROIC or return on assets are augmented by financial leverage to produce leverage returns, levered returns, or return on equity, which was introduced in earlier model. Like I mentioned, DuPont analysis, you have done it in FRE. Majority of the things here are things that you have done in FRE. So anytime they are doing company present and past, just know that it's financial statement analysis that you are doing. But like I said, you have a flow. So you are determining the company's business model, you are understanding the company's revenue drivers, you are looking at the company's profitability, you are looking at the company's operating profit, you are looking at the company's net profit margin, net working capital. Then you are now looking at the company's sources and uses of capital. Where is the capital coming from? Where is the capital going to? Is the capital increasing profitability? Is the capital increasing efficiency? What's the degree of financial leverage and all that? Yeah. And with these few points of mine, I have once again come to the end of this reading.